Canadian oil and gas is a generational opportunity right now, with significant shifts in the way that this country treats its oil and gas sector, and with a brand new opportunity coming from the decline of US shale. There is real opportunity for investors to buy Canadian oil stocks. And the best part is that a lot of these stocks have been trading at significant discounts with all of the short-term headwinds we've seen in the crude oil markets, particularly the increase of OPEC production, the decrease of demand predictions, and just the general apathy towards the oil markets right now. Investors don't want a piece of this when there's so many other opportunities. But that means that a longer term investor can build a giant position in a really high quality company for a pretty cheap price. And today we're going to talk about one of those companies that you should be including if you want to buy into Canadian oil. It is the largest Canadian oil company in Canada. We're talking about Canadian Natural Resources. Today, we're going to talk about why this remains the number one pick for most investors who want to invest in Canadian oil, and why, as the largest producer, they do have some significant advantages that might help them in the longer run. Welcome to Golden Arch Investing. My name is Liam. Here on the channel, we talk about investing in Canada. If that interests you at all, please do like the video, subscribe to the channel. Today, we're going to be covering an article written by Jonathan Weber. I'll throw it up on the screen right here for you. This article covers why Canadian Natural Resources is his number one pick, and I think he does a good job of explaining some of the reasons why a regular Canadian investor who might not necessarily be interested in the oil market entirely, but who wants a little bit of exposure to the resource boom, this big mega cycle going on in Canada, and why this might be the obvious pick for them. So we'll go through this article. I'll give you guys my thoughts, and then we'll talk a little bit about some of the recent news that's come up in the oil market. So again, Jonathan Weber, this is over on Seeking Alpha. If you pay for Seeking Alpha, please do give him a click. It's a good article and he definitely deserves it. Summary of this article: Canadian Natural Resources offers strong growth, a robust 5+% dividend yield, and resilience against low oil prices, making it a compelling investment. That last piece, huge in my opinion. These guys are some of the lowest cost producers in Canada. They've made it a significant priority to be a low cost, sustainable producer. They are in a position that they can basically just stay flat for as long as any of us care as investors. You know, if your time frame is 10, 15, even 20 years, these guys can just kind of sit on their hands and run for 20 years, making gigantic free cash flow. Now, they won't do that because they're interested in growing the company, but downside is really mitigated by their low price. Their low break-even costs and efficient operations drive profitability 100%, even in a weaker macro environment, which is right now. While production and cost controls outperform peers, company boasts 25 years of consecutive dividend growth, rapid dividend increases, aggressive buybacks, and a healthy balance sheet supporting high shareholder returns, and it's valued at just 5 times their annualized funds from operations, which means it provides upside potential, defensive assets, and reliable income. And yeah, I agree with everything on there. To give you a frame of reference, as I film this video, CNQ is trading at $30, just about $30, market cap of $63 billion. It's trading at a P of 12. It's pretty good, honestly. And think about it this way. This is the brand name in Canadian oil. You'd expect it to be trading at a premium. We've talked about that before, that, you know, valuation for these largest companies typically is a little bit higher. 12 PE is hardly premium when you think about what you could be paying for some of these bigger compounding companies. Okay. Thesis here: Canadian Natural Resources is an energy company that combines many positives: solid growth, nice dividend yield, resilience versus low oil prices and macro shocks, and so on. At an undemanding valuation, and CNQ looks very compelling. It's not risk-free, but it looks like a good investment. Well put. Not risk-free. Nothing is. Don't go looking for individual stocks and hoping you're going to find something that's risk-free. Instead, mitigate risks through your own portfolio construction and pick winners. Pick stocks you think are going to win in their relative industries. And CNQ, Canadian Natural Resources here, big winner. Historic winner in the last 20 years, right? Think about where they were 20 years ago versus now. Being a 60 plus billion USD company, insane. This author has written about Canadian Natural Resources before, including in early March. They rated them a strong buy. They expect this is only the beginning of the returns we can expect from CNQ in the coming years. With one quarter having passed since my last article and CNQ reporting its most recent earnings results since my last article, it's time to update my views today. So the macro, this is what a lot of us care about. And again, if you're like not necessarily a beginner investor, but if you're somebody who's not super into Canadian oil, the macro is really what you got to care about, because there's a lot of elements here that if you don't understand, this investment doesn't make sense. If you're thinking about this from an outside perspective and you're somebody who's not necessarily a huge oil bull, which, let's be fair, in the investing community as retail investors, there's not a huge number of just sort of oil bulls in general. People aren't out here buying oil for no reason. Instead, there's people who see macro trends that they think they can take advantage of. Me personally, the macro trend that I have been looking for here in Canada is one, sentiment shift towards Canadian resources. I don't think that's even arguable anymore. If everybody in Canada, be the most progressive to the most conservative, is on the same team saying, yeah, we got to invest in this country, hey, macro shift right there. Second, decline of US shale. Big story. It's one of the stories being put out by Eric Nuttall, who's a big name in this industry. It's one of the stories being put out even by some US shale companies where, hey, tier one inventory is sort of drying up, costs a lot to operate US shale. Now they've managed to expand dramatically beyond what any of us expected, seeing them become the number one producer on earth, but that can't last forever. So the decline of US shale means there's now an opportunity for some of the lower cost basins to survive this little fight for market share that the Saudis and OPEC as a whole has put on, and then sort of take their place. And in the North American market specifically, there's nobody more convenient than Canada. And then third is the infrastructure. Let's not call it a boom, but the potential for infrastructure development, unlocking Canadian oil and decreasing the differential, which is essentially what makes Canadian oil, WCS crude, so much cheaper than WTI, which is essentially a factor of geography. It's locked up inland on this side of the Rockies, on the east of the Rockies, in northern North America, a long way from any tidewater. And the tidewater it can get to has to get shipped through pipes that cost an exorbitant amount to make, both thanks to all sorts of legislative challenges, sure, but also just geography. I mean, the TMX pipeline is one of the most incredible engineering feats of our lifetime, for sure. And the fact that they were able to do some of the things they did, huge props to all the engineers who worked on that. But still, incredibly costly. It's quite difficult to build more pipelines, even ones that might be less technically demanding. And it's become this huge political fight. So, with that in the way, it's kept Western Canadian Select cheap. But as we get the sentiment shift that I talked about earlier, now there's the potential, again, no promises are being made, but the government's talking big about how they're going to actually get some of this stuff done. And by government getting it done, it means they're going to actually allow the industry to build it. Now, again, that is definitely the third point because it's probably the most up in the air. But if all those things go together, Canadian crude and specifically the stocks that produce it are suddenly going to be dramatically higher valued than they are right now, because they need to be, because they are trading at cheap multiples. Their assets are undervalued. They're going to need to boost. And you're going to see a 5-10 year super cycle like you saw sort of running up into that 2014 era at the peak before US shale came on and sort of took so much market share and all that happened. That's my personal macro outlook. So let's see what the author has to say here. Canadian Natural Resources has, compared to many other energy companies, a relatively resilient business model, thanks to low break-even costs that allow it to remain profitable in most energy price environments. I think in their most recent earnings call, which we read out on the channel and covered, they said that they were good down to the 40s range. So if we're at 60, even after all the drama, they got some room to sort of buffer. They got some room there. Macro picture is less important for C&Q like its peers. In 2025, oil prices have come down so far. WTI crude oil trading in the low 60s right now. I think it's like at $60 a barrel as I film this. This is largely due to worries about global demand, with some analysts and investors seeking the current trade tensions between the US and other markets as a reason for lower oil demand in the future. While it is possible that oil demand will take a hit during potential tariff-induced recession, players like OPEC are forecasting solid demand growth for the current year, as well as for next year on a global basis. At 1.3 million barrels per day for each year, this is driven by a healthy economic growth in markets such as India, by growing air traffic, and so on. Even if oil demand were to decline somewhat in the US, demand growth in other markets could more than offset that headwind. I thus am not bearish on oil markets in general, as the underlying demand growth trend driven by fast growth markets like China and India remains intact. Geopolitical crises and shocks could result in supply disruptions like tensions with Iran, and thus it's possible that oil prices rise substantively from here. Well, I think that it is unlikely that they fall a lot from here. So interesting, they think there's a lot more room to go up than there is to go down. I'm definitely interested by that. Again, I'm not necessarily a huge oil bull on the macro stage. I don't know where oil is going to go. And I think that's because oil is so dependent on not only the economy, but geopolitics. And let's be honest, have any of us managed to guess what would happen geopolitically over the last 5 years? If you say yes, you need to start playing the lottery because you can see the future. Geopolitics has been insane for the last 5 years. We've seen crazy things go on. And honestly, it has been a real challenge for a lot of oil companies. Canadian, on the other hand, right, you heard my thoughts. I think we're in a sort of special pocket, but hey, this author is pretty bullish on the whole industry. That's really interesting. Compared to the trading range over the last couple of years, oil is currently rather inexpensive. 3-year trading range is from $55 to $115. Oil thus seems relatively cheap right now, with price normalization likely being more of a tailwind than a headwind going forward. I will say, I'm going to put a little asterisk there. 115, unless you see another major land war in Europe, I don't think we're jumping to 115 again. C&Q specifically, very compelling operational performance. While oil price movements and to a lesser degree natural gas price movements impact C&Q's results, so does the way the company operates. Canadian Natural Resources' ability to keep cost controls tight and to grow production impacts profitability and cash flow generation a lot as well. Things look pretty good here in the recent past. Earlier in May, the company showcased its most recent earnings result, delivering what I think was a very compelling operational result. Canadian Natural Resources was able to grow its output measured in barrels of oil equivalent per day up to 1.58 million during the most recent quarter, which is up a very strong 19% compared to 1.33 million barrels equivalent 1 year earlier. Usually major oil companies, grow their production by a couple of percent points per year. They grow their production at all, but C&Q grew its output by almost 20% in a single year. Partially due to M&A, I would say mainly take over AOSP and the Duvernay assets in the fourth quarter. Athabasca Oil Sands Project, AOSP. But even adjusted for that, production growth would be significantly ahead of the peer group. In situ production, for example, was up 6% year over year as well and was not impacted by M&A. So what the author's saying here, they're acquiring new assets, yes, but they're also becoming more efficient with their existing ones, which is good. We want to see that as investors. As owners of this company, we like to see efficiency increase and production levels increase. At the same time, Canadian Natural Resources cost performance was strong, with light crude oil production costs dropping 14% on a per barrel basis, while North American natural gas production costs declined by 9%. Even better, C&Q's thermal in-situ production costs dropped by a hefty 20% on a per barrel basis during the most recent quarter. As a result of efficiency investments, operating leverage, and cost-cutting measures such as automation. Management seems to be very focused on keeping cost controls tight and improving efficiencies where it is possible to do so, which I very much like as a shareholder. After all, production growth alone would be overly attractive if it came at the cost of declining efficiency, but this is clearly not the case at C&Q. Between these factors, C&Q managed to generate adjusted funds from operations of $4.5 billion during the quarter, or $18 billion annualized. Even after accounting for capital expenditures both for maintenance and future growth, planned at $6 billion this year, that would mean $12 billion of free funds flow available for dividends, buybacks, and debt reduction. Since Canadian Natural Resources already has a relatively clean balance sheet, there's no need to focus on debt reduction too much. So let the majority of the company's free funds flow, such free cash flow, will go towards shareholder returns, which brings us to another major pro argument for investment in C&Q. This bit was probably what started my interest in C&Q, I will say, the shareholder returns. Due to the fact that energy price movements can result in swings in the profits of energy companies, the overtimes don't have long dividend growth track records. C&Q is a bit of an outlier, however. It has raised its dividend for 25 years in a row, giving it dividend aristocrat status. But unlike Chevron and Exxon, which also have decades-long dividend growth, C&Q is growing its dividend very quick. So you look at dividends paid and you see the chart there. You look at shares outstanding, you see the chart there. So purple line is C&Q, and in both cases, they are outperforming. You want to see the top chart, the purple line, go up. You want to see the bottom chart, the purple line, go down. Again, if you're not super deep into this, one of the big stories in oil right now is buybacks. If you can't increase production because of the geographic and sort of political limitations, well, you can increase per share efficiency. And by doing buybacks, you do exactly that. So yeah, you can't dramatically grow revenues, but you can grow your EPS by buying back shares. And you see they've bought back shares much quicker than Exxon or Chevron, which again are the super majors. These are these huge American companies. They also have increased the dividend much faster. Over the last 5 years, C&Q grew its dividend by about 170%, about 5 times the growth seen at CVX, and 15 times the growth seen at XOM, so Chevron or Exxon. the same time, CNQ is also the best pace of share repurchases, reducing its share count by double digits on a net basis. Some other energy companies have achieved high dividend growth rates in recent years as well. These have oftentimes cut their dividends during the pandemic. I'm not going to paint everybody with a brush there. There are fantastic energy companies. We talk about them often. A lot of them are Canadian. I mean, hey, that's my bias showing, but a lot of them are Canadian. But those up, CNQ combines a long dividend growth streak, spanning all kinds of crises with very strong dividend growth rate, both over the last 25 years and over the last couple of years. Note the bump in the CNQ dividend chart is due to a special dividend. Hence, they didn't actually cut the dividend, so that they gave it a special dividend and therefore it looked higher. Make things even better, they offer a strong yield of 5.2%, which is well above the average for energy companies. It is also a fantastic dividend rate for a growing dividend stock that actually has share price potential. Let me just say that right now. If you're one of those folks that's a dividend growth investor, which I definitely do subscribe to that. I'm not uniquely a dividend growth investor, but I do like that in our Canadian tax advantage accounts because we have advantages that Americans don't have, which is why when you see the argument on the internet, you often see there's no point buying dividends, you're just taxed out. And I'm like, hey, my TFSA, I don't care. But I do love the dividend for CNQ, and I love that it's attached to a company with potential. I think the biggest problem if you look for just dividend yield, and this could be a standalone video for sure, some people buy for the yield. We saw this with BCE recently, where they were buying into a stock that's on the decline with significant headwinds, with management that clearly was not really seizing the moment because the dividend yield was crazy. I mean, heck, if you could make a 13% return per year as a dividend, wouldn't you want that? Well, yeah, if all else stays equal. And I mean, if you want to do that, go look at preferreds, go look at BDCs. Go look at something else. But if you want common stock with a nice high dividend, you need it to be attached to a good growing company. CNQ fits that for me. Final thoughts. CNQ's oil sands assets are very low decline, long lasting assets. There's no meaningful exploration risk, and thanks to low break even costs and declining production costs, CNQ is well positioned to remain profitable in almost all macro environments. Ongoing growth investments and occasional takeovers result in a nice growth rate, and on a per share basis, growth is even better thanks to CNQ's buybacks. If a recession were to happen, oil prices could decline from here. CNQ would possibly see its shares pull back as well, but oil prices are not currently close to the lows of the recent trading range, which is why I do not believe we'll see another steep drop. CNQ is already priced very inexpensively at just 5x Qs analyzed funds from operations. All in all, CNQ combines a strong return outlook due to valuation upside, underlying business growth, a 5% plus yield, and buybacks, with considerable resilience due to its defensive low-risk assets and proven ability to grow with a dividend during times of crisis. That's why CNQ is currently my biggest energy investment. So I'll say a couple things. I want to give my thoughts here. And I also do want to talk a little bit about some news stuff, some macro stuff. So I am filming this video on Saturday afternoon. I'm going to release it Sunday morning. So I'm filming it on the 31st of May. I'm releasing on the 1st of June here. As of filming this video, we've got some really big stories in the oil world. There's a story about CNQ, this company signing a 15-year deal to supply a U.S. LNG exporter. So somebody who's going to take that natural gas through a pipe and is then going to export it on to the markets of probably Europe. Let's be honest, that's the biggest demand right now. But also potentially through the Panama off to Asia and all over, right? All over. The U.S. LNG market's growing exponentially. But still, point is, they're looking for 15 years of demand from CNQ. They're willing to sign that deal. We have heard the argument being made many times when government got in the way of major contracts for LNG export capacity here in Canada. And they declined permits, or they argued against it, and they acted against it. We heard many times the phrase, there is no business case for Canadian LNG. Clearly that's wrong. Clearly that is no longer true here in 2025. So that's a great story to have in the headlines. As the second big news piece, this coming Monday, at the beginning of June here, we are going to see the first ministers meet in Canada. That means all the premiers and the prime minister are going to put their heads together. And specifically, we've seen this all over the airwaves. They are coming together to propose major economic and infrastructure projects to the prime minister for fast-tracked approval. One that we have talked here on the channel is the concept of the Western Canadian Economic Corridor, an idea of pipelines, rail lines, tying together all of the prairie provinces, British Columbia, and exporting through the Port of Churchill in Manitoba. Gives us an opportunity to export to the east of Canada without having to argue with Ontario and Quebec over building pipelines through their sort of territory. And it puts us in a position where we can sort of increase some of our resource industries in the north of the prairies. This is one of the richest places on earth when it comes to natural resources, not just oil. I should say that, not just oil. Oil has one of the best opportunities thanks to the market dynamics of the public markets here in Canada. But there are amazing, amazing opportunities in all these resources. And we have talked about that project on here. But we could also be seeing some sort of actual east-west pipeline proposed. We could be seeing some sort of, West Coast pipeline proposed. We could see some sort of movement there. And I expect that to move stock prices. And I expect CNQ to be a big winner or a big loser, depending on what happens. So that's definitely a thing to look for. If you're watching this video, if you're interested in the stock, pay attention. What happens on Monday? I'm almost 100% positive I will take the opportunity to do a video on this, regardless of what happens as they come out of that meeting. But I want to hear not only what Prime Minister Mark Carney has to say, but I want to hear what the various premiers have to say, be it, Wab Kinew with his proposal for Manitoba, maybe Danielle Smith, right, as the Premier of Alberta, where I am from here. She's obviously a big proponent of pipelines, right? She tends to argue against the federal government for political reasons. But of course, she's probably the most aligned with energy shareholders. So if she sounds disappointed, maybe we're going to see the stock market react. If she sounds less disappointed, she's not going to say, yay, go Liberals. Why would she? That would make no sense. But if she sounds maybe a little bit more optimistic, or she sort of projects optimism or name drops a project or something, right? Something positive from her, we're going to see, stocks move. I'd expect this to be aftermarket Monday. So we'll probably have an opportunity to do a video before we actually see the movement in the markets, but hopefully we'll get some sort of direction there, some sort of concrete action. And we'll actually see, like, hey, are they going to live up to their word? Are they going to do some of these projects? Are we going to see this happen or not? Are we going to see any movement on legislation that has been sort of a big sticking point in this industry? The industry really, really doesn't like Bill C-69. They don't like it. The Impact Assessment Act, they don't like it. They think this is bad. We have seen a lot of talk about the idea of aligning environmental and sort of assessments, impact assessments for big projects like this, aligned between the provinces and the federal government. Do we see action on that? Could there be one assessment for one project? And could it take 2 years? Are we going to see some sort of concrete action? I expect that Monday is where we hear, a little bit more direction. And yes, I talk on this channel a lot about, naturally political topics. But remember, politicians are going to politician. Don't trust them at their word. Never trust a politician just based on what they say. Let's see what actually happens. And obviously, when we've got this sort of meeting like this, where politicians that are just naturally opposed to each other, they don't like each other, come together. If we see them agree on something, huge. So I think there's some really huge macro stuff going on. And CNQ is the big dog. So they're probably the ones that'll benefit the most. If you think of who has the potential to dramatically increase their production, well, it's CNQ. Who has the potential to make the long-term investments that make a significant new pipeline project possible? CNQ is going to be in that discussion. They're not going to be alone, but they need to be in that discussion, and it will materially impact us as shareholders. Last thing I do want to talk about, this stock has gone basically nowhere for a year. And so the longer we see stagnation at these prices, while we see fundamentals, while we see acquisitions, while we see all of these positive business news stories hit the market, as we see all these sort of positive tailwinds hit the market, there is going to have to be sort of catch up in the stock price. So building a position at these prices might become much, much more important if you see big news stories, because the stock price won't stay here forever. So again, we could see negative news and it goes down, but there might be an opportunity to build a position here. And that's definitely the approach that I personally am taking, because again, these guys have a really low downside risk, sort of from a business perspective, and quite a high upside potential. When you see those opportunities, you take them. Now, those are just my thoughts on a couple of big macro events going on. Again, we will talk in more detail about some of this in the not so distant future. I expect that video to be probably Monday night if I get enough information. Might have to come out on Tuesday, depending on again, like, do we see them come out of that meeting on Monday and immediately give us news stories that we can talk about? Or is it kind of just sort of, oh yeah, we'll meet again and talk again and nothing happens? If we see something move, I'll talk to you guys about it. If not, we're going to have to wait. But either way, thank you so much for watching this far in the video. It means a huge amount to me. We're coming up on 2,000 subscribers, which I never thought would happen on this channel, to be honest. I thought I would just be sitting here talking to my camera alone, and it's been fantastic. So leave a comment down below what companies you'd like us to cover next, what topics you'd like us to cover next, the things you want to sort of see here on the channel as we keep going. And again, if you like the video, please like it. If you haven't subscribed to the channel, please do subscribe. And I hope I'll see you in the next video.